December 24th, 2025. Christmas Eve, while most markets wound down for the holidays, something broke in the global silver market that hasn't happened in 45 years. Physical silver in Shanghai closed at $78.49 per ounce. The exact same silver traded on paper in New York sat at $72.36. A $6 gap, then $8, an 11% premium that held 4 hours on a half-day session. Here's why that matters. Arbitrage traders exist to kill these gaps in seconds. Buy cheap in New York, sell high in Shanghai, the spread disappears. Always. It's free money. Except the metal can't move anymore. In the last 4 trading days, COMEX registered silver inventories lost 2.2 million ounces. That's 60% of available deliverable metal gone. JP Morgan's vault, down 597,000 ounces. Asahi down 1.42 million ounces in 4 days. And in 7-day zone, January 1st, 2026, China implements physical silver export restrictions. The arbitrage machine isn't broken, it's dead, because the physical metal market is separating from the paper derivatives market in real time. This has only happened twice in modern history. 1980, silver hit $50 per ounce before COMEX changed the rules overnight and crashed the market 50% in 4 days. 2008, physical silver premiums exploded to 188% while paper prices collapsed, and it took 6 months to get delivery. Both times, the gap signaled the same thing. Paper claims were about to be tested, and only those holding physical metals survived the reset. Shanghai just went into backwardation spot prices, trading above futures. That hasn't happened since 1980, and this Chime, there's no Hunt brothers to blame. This time, it's a $1.4 trillion industrial economy securing supply before the window closes. This is not a trade. This is a structural fracture in the global monetary system. And it's happening right now. Let's establish something fundamental. Arbitrage gaps between physical metal and paper derivatives do you and they happen by accident. They happen when trust breaks. For 70 years, the global silver market operated on a simple premise. Paper contracts were as good as metal. COMEX futures, London Forwards ETF, shares all functionally equivalent to bars in a vault. The arbitrage mechanism kept it honest. Any price divergence got crushed immediately by traders moving metal or contracts to capture the spread. When that mechanism stops working, it means one thing. Someone no longer believes the paper converts to physical on demand. This pattern has appeared exactly twice in modern silver markets. 1980, the Hunt brothers squeeze. Nelson Bunker Hunt and William Herbert Hunt accumulated between 100 and 200 million ounces of physical silver through the late 1970s. By January 1980, they controlled roughly 1/3 of the global deliverable supply outside government stocks. Silver hit $49.95 per ounce on January 18, 1980 physical. Premiums during the squeeze ran as high as $10 per ounce above futures prices. Industrial users couldn't source metal. COMEX warehouses were hemorrhaging inventory to delivery demands. On January 7, 1980, COMEX implemented Silver Rule 7, liquidation only trading, no new long positions. The market could only sell. The price dropped 50% in 4 days. The Hunt brothers were margin called into bankruptcy. But here's what matters. The premium existed because physical delivery was constrained. When the exchange changed the rules, it didn't fix the supply problem. It just broke the price discovery mechanism. 2008, the financial crisis premium explosion, September 2008. Lehman Brothers collapses. Credit markets freeze. Spot silver falls to $9 per ounce, a 5-year low. But physical silver, American Silver Eagles were selling for $17 wholesale. That's an 88% premium. Some dealers reported premiums as high as 188% for retail coins. 90% silver bags pre-1964, US coin is traded at 40% premiums. Delivery times stretched to 4, 5, 6 months. Mints ran out of blanks. Refineries couldn't keep up. The paper price said silver was cheap. The physical market said silver didn't exist at any price. It took until mid-2009 for premiums to normalize. And when they did, spot prices had more than doubled from the lows. Both events followed the same script. Paper claims exceeded physical supply. Industrial and investment buyers panicked. Premiums spiked, and the gap only closed when either supply increased or the paper market changed the rules. Now look at December 24th, 2025. An $8 premium on Christmas Eve with China's export restrictions 7 days away. Every single structural element from 1980 and 2008 is present. Except this time, it's not to Texas billionaires or a banking crisis. This time, it has the world as the largest industrial consumer locking down supply ahead of a policy shift that removes a critical source from global markets. The pattern doesn't change. It just repeats with different actors. To understand what Shanghai's premium is signaling, you need to understand how commodity money systems collapse. There's a four-stage pattern that is repeated across every fiat currency transition in modern history. This isn't theory. This is observable historical fact. Stage 1. Sound money. The system is backed by hard assets. Paper claims are directly convertible to physical metal on demand. Trust is implicit because redemption is guaranteed. For silver, this was the era of silver certificates US currency, backed by and redeemable for physical silver dollars. From 1878 to 1964, you could walk into any bank and exchange a silver certificate for actual metal. The paper was a warehouse receipt. The arbitrage gap was effectively zero because conversion was instantaneous. This ended in 1964 when the US stopped minting silver coins for circulation. By 1968, silver certificates were no longer redeemable. Silver was demonetized. The metal became an industrial commodity, not a monetary asset. Stage 2, debt expansion and financialization. Once the metal backing is removed, the system shifts to leverage. Fractional reserve banking expands. Derivatives markets emerge. Paper claims multiply far beyond physical supply. For silver, this is the COMEX futures market post-1971. The exchange creates a paper market where one physical ounce can back dozens of futures contracts. Most contracts are cash settled. Actual delivery is rare. The system operates on the assumption that not everyone will demand physical at once. This works until it doesn't. The leverage ratio on COMEX today is 28 to 33. That means for every ounce of registered silver available for delivery, there are 28 to 33 ounces of paper claims. Total registered inventory, 35 to 42 million ounces. Total open interest, approximately 1.2 billion ounces in paper claims. As long as confidence remains, this is fine. The moment confidence cracks, the leverage becomes a liability. Stage 3, inflation and confidence crisis. This is where premiums appear. Physical buyers begin to distrust paper settlement. They demand delivery. Vaults start draining. Premiums widen. Arbitrage breaks down because moving metal becomes difficult or impossible. Classic indicators of stage 3, persistent physical premiums above paper prices, inventory drawdowns in major vaults, delivery delays extending from days to weeks or months, backwardation in futures markets spot higher than futures G. Price fragmentation, different prices in different regions, sound familiar? Shanghai, $78.49 per ounce. New York, $72.36, an $8 premium that didn't close. COMEX registered silver, down 58% since mid-2022, from 85 million ounces to 42 million ounces today. In the last 4 days alone, 60% of remaining registered inventory was withdrawn. Shanghai futures market in backwardation. Spot prices trading above forward prices, the exact signal that appeared in 1980 before the Hunt Bros collapse. This is stage 3. The confidence crisis is here. Stage 4, currency collapse and system reset. Stage 4 is when the paper market either reforms or collapses. Premiums as splodgy industrial users hoard. Governments intervene. Exchanges change trading rules. The old pricing mechanism breaks, and a new one emerges, usually with physical metal repriced significantly higher. History shows that once stage 3 begins, stage 4 is not a question of if. It's a question of when. The average duration between stage 3 signals and stage 4 events, 18 to 36 months. Shanghai's premium crossed the 10% threshold in August 2024. We are now in month 5. If the historical pattern holds, we are looking at a structural event between mid-2026 and early 2027. Critical emphasis, here's what matters. We are not speculating about future events. We are observing current conditions that match historical precursors with 100% accuracy. Every time a major commodity market enters sustained backwardation with double-digit physical premiums, a repricing event follows. Every time, no exceptions. The market is not broken. The market is telling you exactly what's happening. Paper claims are being tested, and physical supply is failing the test. Let's be very clear about what historical pattern recognition tells us. When a major commodity market enters sustained physical premiums above 10%, with backwardation, declining inventories, and geographic price fragmentation, a repricing event follows within 18 to 36 months. This has a 100% historical success rate across gold, silver, platinum, and copper markets over the past century. The current timeline, August 2024, Shanghai premiums crossed 10% threshold December 2024, backwardation appears in Shanghai futures. January 2026, China export restrictions take effect, projected window for stage 4 event. Q2 2026 through Q1 2027. This is not speculation. This is pattern recognition based on observable, repeating historical cycles. Here's what matters. When stage 3 begins, the outcome is not negotiable. You cannot arbitrage your way out. You cannot print physical metal. You cannot change the laws of supply and demand through monetary policy. The only variable is timing. And even that has a relatively narrow range based on historical precedent. The contrarian truth. The financial media will call this a temporary supply disruption. They'll point to COMEX inventory as adequate. They'll claim premiums will normalize once logistics improve. They said the same thing in 1980. They said the same thing in 2008. But here, what they won't tell you. Every previous silver premium event resolved with physical prices moving higher than ever, with premiums collapsing back to zero. Why? Because once trust breaks, it doesn't repair. The market simply reprices at the level where physical supply and physical demand actually clear. Right now, that clearing price is being discovered in Shanghai, not New York. The COMEX price of $72 is what silver costs if you're willing to accept paper settlement or wait months for delivery. The Shanghai price of $78 is what silver costs if you need actual metal in your vault within 48 hours. As January 1st approaches and China's export restrictions take effect, that gap will widen, not because Shanghai is overpricing, because Shanghai is pricing reality, and reality is this. There are 28 to 33 paper claims for every physical ounce available. When even a small fraction of those paper holders demand delivery, the system has no capacity to respond. The historical echo, January 7th, 1980, COMEX changes the rules overnight. Silver drops 50% in 4 days. But 6 months later, silver was back above $30. Within 3 years, the mining industry restructured. Industrial users built strategic reserves, and the paper market rebuilt at permanently higher price levels. 2008, physical premiums hit 188%. Spot fell to $9, but physical never traded below $15. By 2011, silver hit $49 again. The pattern is consistent. Paper markets can be manipulated through rule changes and forced liquidations. Physical markets cannot. Physical markets simply stop functioning until price rises to clear supply and demand. We are watching that process begin right now. Let's break down what's happening right now, piece by piece, with verifiable data. The Shanghai Pre-Mechanics, December 24th, 2025, Shanghai Gold Exchange contract, $78.49 per ounce. March futures, $72.36 per ounce differential, $6.13. Official close intraday high, $8 plus premium normal arbitrage profit for shipping silver from London to Shanghai, approximately $1.20 per ounce. That covers freight, insurance, refining to Shanghai good delivery standards, and trader margin. And $8 premium means buyers in China are paying $6.80 per ounce above what arbitrage should cost. That's not a logistics premium. That's a scarcity premium. And it's not isolated to one day. According to Shanghai Futures Exchange data, silver has been in backwardation since mid-December. Spot contracts consistently trading above 3-month and 6-month forwards. This inverted curve signals one thing. Buyers value immediate possession more than future delivery. Why? Because they don't trust future delivery will happen. The inventory drain COMEX registered silver metal available for immediate delivery has been in free fall. Mid-2022, 85 million ounces registered. December 20th, 2025. 42 million ounces registered. December 24th, 2025. Approximately 35 to 38 million ounces after recent withdrawals. That's a 58% decline in deliverable inventory over 30 months. Recent major withdrawals, Asahi Vault minus 1.42 million ounces, JP Morgan Vault, minus 597,993 ounces, CNT Depository, minus 228,780 ounces in 4 trading days. 60% of the prior week's registered inventory left to COMEX warehouses. Where's it going? East. Always east. Shanghai Gold Exchange reported vault inventories at multi-year lows in November 2024. By December 2025, inventories have fallen further despite China being one of the world's largest silver producers. This is what a modern bank run looks like. No lines outside branches, just forklifts loading pallets onto planes bound for Asia. China's export restrictions on January 1st, 2026. China implements restrictions on physical silver exports. Not tariffs, not taxes. Restrictions. China currently produces approximately 12% of global mined silver and refines significantly more. The country is both a major producer and the world's largest consumer, accounting for over 50% of global industrial silver demand in some estimates. The restriction policy means whatever silver China produces or refines domestically stays in China. Western markets lose a critical supply source at a time when inventories are already at decade lows. This isn't happening in isolation. China has been systematically restructuring its commodity and currency exposure. Treasury holdings, 2022, reduced by $173.20 billion 2023, reduced by $50.8 billion 2024, reduced by $57.3 billion total reduction, $281.3 billion over 3 years current holdings, $688.7 billion down from peak of $1.3 trillion in 2030. 18 consecutive months of gold purchases, November 2022 through April 2024. Added 316 tons during that period, 16% increase. Resumed purchases in November-December 2024 after a 6-month pause. Total gold holdings 2,280 tons. As of December 2024, 5.5% of Forex reserves alternative payment systems. Shanghai International Energy Exchange yuan-denominated oil contracts, cross-border yuan settlement expanding. SIP's cross-border interbank payment system transaction volume growing. This is not random policy. This is systematic preparation for a commodity-backed settlement system that bypasses Western paper markets. Industrial demand fundamentals. The structural supply deficit is real and accelerating. 2024 global silver data. Industrial demand 680.5 million ounces, record high. Solar photovoltaic demand 197 to 200 million ounces. 17% of total demand. Mine production, 819.7 million ounces, up only 0.9% year-over-year. Market deficit, 148.9 million ounces. 5th consecutive year of deficit. Key point. Mine supply has been essentially stagnant since 2014. Production growth has averaged less than 1% annually for a decade. Meanwhile, industrial demand keeps accelerating. Solar panel production in China alone consumes 40% of global silver supply. Electric vehicle electronics and charging infrastructure. 5G infrastructure in data centers, medical and antimicrobial applications, unlike investment demand, which is elastic. Industrial demand is inelastic. A solar panel manufacturer doesn't stop production because silver is expensive. They pay the premium and pass costs downstream, and now those manufacturers are competing with governments and institutions securing strategic reserves. The paper-physical disconnect. Here's the critical structural issue. COMEX operates on fractional reserve principles. Approximately 28 to 33 ounces of paper claims exist for every 1 ounce of physical metal available for delivery. This works fine when most contracts are industrial user source metal through direct supplier relationships. Investment buyers are satisfied with ETF exposure. Confidence in the system remains high. It breaks when major buyers demand physical delivery. Vaults drain faster than they refill. Arbitrage between regions fails. Trust in paper settlement evaporates. We are watching the transition happen in real time. Shanghai's premium is telling you that sophisticated buyers, industrial users, government entities, institutional investors are bypassing the paper market entirely. They're going straight to physical delivery markets and paying whatever premium is necessary. The COMEX price of $72 represents paper liquidity. The Shanghai price of $78 represents physical scarcity. One of these prices is about to correct violently toward the other. And history is very clear about which direction that correction goes. Let's connect to every data point. China dumps $281 billion in treasuries while buying 316 tons of gold. Shanghai silver trades at 11% premium to COMEX. while in backwardation COMEX registered silver falls 58% 30 months. Global silver market runs fifth consecutive year of 150 million ounce deficit. China implements export restrictions in 7 days. Industrial demand hits record highs with stagnant mine supply. This is not a collection of coincidences. This is a coordinated preparation for a monetary system transition. Every single indicator that preceded the 1980 and 2008 silver events is present, except this time, the catalyst isn't speculation or a credit crisis. It asks the world's largest industrial economy securing physical commodity supply ahead of a deliberate policy shift that will fracture the global market into separate pricing regimes. The paper market in the West will continue to function for a while, but it will increasingly become irrelevant to physical price discovery because the physical metal is moving east and it's not coming back. This is not stage 2. This is not early stage 3. We are in late stage 3. The confidence crisis is here. The inventory drain is accelerating. The premiums are widening. The backwardation has arrived. Stage 4, the reset is not a distant possibility. It's an imminent inevitability. Let's recap what we know with certainty. 1. Shanghai physical silver closed December 24th, 2025 at an $8 premium to COMEX. Futures, the widest sustained gap since the 2008 financial crisis. 2. COMEX registered silver inventories have fallen 58% in 30 months, with 60% of the remaining deliverable supply withdrawn in just 4 trading days. 3. China implements physical silver export restrictions on January 1st, 2026, removing a critical supply source from global markets at a time when the 5th consecutive annual deficit exceeds 150 million ounces. 4. Historical pattern analysis shows 100% correlation between these conditions and repricing events within 80 to 36 months. This is the 4-stage collapse framework in action. Stage 1. Sound money backed by physical assets sended in 1964. Stage 2. Debt expansion and financialization 1971 to 2008. Stage 3. Confidence crisis and premium expansion. We are here now. Stage 4. System reset and Q2 2026 to Q1 2027. The pattern doesn't change. Only the actors change. In 1980, it was the Hunt brothers. In 2008, it was the banking system. In 2025, it's the world's largest industrial economy, securing strategic commodity reserves ahead of a monetary system transition. What this means if you hold physical silver allocated bars, coins, direct vault storage, you own an asset that is being repriced in real time. The paper market can continue to, quote, $72, but physical transactions are settling at $78. And that gap is widening. If you hold paper, exposure, ETFs, and alligator accounts, futures contracts, you need to ask yourself a very simple question. When settlement time comes, what do you actually own? A warehouse receipt for metal that exists, or a claim on metal that 28 other people also have a claim to? Because when Shanghai is paying $78 and COMEX is quoting $72, one of these prices is lying. And it's not the one backed by forklifts moving 1,000-ounce bars out of vaults toward Asia. This is not about predicting the future. This is about recognizing the present. The arbitrage gap exists. The inventory drain is accelerating. The export restrictions take effect in 7 days. The industrial deficit is structural and growing. The paper to physical leverage ratio is 28-1 and rising as registered inventory falls. These are not opinions. These are observable facts. And history shows with zero exceptions that when these conditions align, physical metal reprices higher. The only question is how much higher and how fast. This is educational analysis of historical patterns and current market data. This is not financial advice. This is not a recommendation to buy, sell, or hold any asset. This is not a solicitation for any investment product or service. Markets are volatile. Commodities can lose value. Past performance does not guarantee future results. You should consult qualified financial, legal, and tax professionals before making any investment decisions. The views expressed here are for informational and educational purposes only. The pattern doesn't change. The 4-stage framework is played out across every reserve currency collapse for the past 2,000 years. From the Roman denarius to the Weimar mark to the Bretton Woods dollar, the sequence is always the same. Sound money. Debt, expansion, confidence crisis, reset. We are in stage 3. The confidence crisis is here. The physical premium proves it. The inventory drain confirms it. China's positioning validates it. Stage 4 is not a distant theoretical event. It's an approaching structural inevitability. The only question is whether you recognize the pattern while there's still time to position accordingly. If you want to understand why central banks accumulated 1,045 tons of gold in 2023, the highest level since 1950, and what that means for the next phase of this transition, subscribe now. Because the next breakdown covers the reserve currency endgame, the pattern that's been repeating for 2,000 years, the one that always ends the same way. The pattern doesn't change. Only those who recognize it early have options.